on NPV, we'll continue with the same. Now, we'll first understand what is NPV. We'll just revise it. So, NPV is nothing but the net present value. We're doing the investment decision techniques module in which a particular individual or a particular entrepreneur has to decide in which projects he wants to invest, because he doesn't has so much capital that he can invest in all the investment opportunities. So suppose he has 5 projects and he has limited amount. Out of 5, he has to select one and invest in that. So out of those 5, which one to select, to decide that we do the investment decision techniques. Now if you decide it on your own judgment, sometimes you may go wrong. If you feel that investing in pharmaceutical sector would be more beneficial than into a garment manufacturing sector, only on your gut feeling, then you may go wrong, because the industry keeps changing every now and then. So that's why that how are we going to invest and where we should put our money. Now to do that, there are two types of techniques. One is the discounting and the non-discounting technique. Under discounting technique, we consider time value of money. But in the non-discounting techniques, we don't consider the time value of money. That is the only difference why we call them discounting, non-discounting. Now, under discounting techniques, the very first one that we have is net present value, which we also call as NPV. This is a popularly used technique by many financial managers and companies to analyze whether they want to invest in a particular project or not. So, how do we find the NPV? To find the NPV, the formula is present value of cash inflows minus initial investment. Now, what is this present value of cash inflows? It is nothing but whatever you have earned in the next 3 or 4 years, you get it to today's value. So, get it to present value and minus it with the cost or the investment that you're making today in the project. So, we need two things. One is the present value of cash inflows, and the next is the initial investment. If we have these two things, we can easily find the NPV. So now let's get into solving one problem so that we understand how actually this NPV works. So from the following details, calculate NPV for the two projects and comment on the selection of the project. Assume cost of capital to be 12%. So here there are two projects, project 1 and project 2. The company is not able to select among the projects. So it is asking your help. It is asking you to decide and let us know which project is feasible. And they have said that you can use the cost of capital as 12%. So let us understand which project is feasible by calculating NPV. So the very first method is we will find the present value of cash flows. Now when we say we'll find the present value of cash flows, we need only the cash inflows. At year 0, what is given is the cash outflow. If you see, it's written in the bracket, that means it is going out. That means you're investing that money. Even if it is not written in the bracket, or even if it is not with a minus sign, if it is in year 0, we basically invest. So we consider it as initial investment. So that 1 lakh rupees is initial investment. Now what we need to do is we need to find the present value of cash flows from year 1 to year 6. Project 1 is earning these cash flows and project 2 is earning these. So let's do it individually for 1 and 2. I'll show it in an Excel sheet for you so that it becomes easy. So the first column that we will have to make is year, then the cash inflows, year cash inflows, then we need present value interest factor at the cost of capital. What was given in the question is 12%, so we need it at 12%. Then we find present value of cash flows we're doing first for project A. Is it visible to all of you?
Yes, ma'am.
Yes, ma'am.
So there's 6 years. We'll do it for 6 years. Let me take the cash flows of project A for 6 years. So these are the cash flows. Now we have to find the present value interest factor at 12%. 12% is the cost of capital which the company has given you already. We usually use that cost of capital as discount rate to find the present value of a cash flow. So to find the present value of cash flow, we need to see the present value tables. So this is the present value interest factor table. Just see here, the heading itself says present value interest factor. Right? Now here we want to check at 12%. So if you're seeing horizontally, we have 1%, 2%, 3%, 4%. Similarly, till 10% is here, 12% is below. Let's go down. So here is 12%. Okay, so 12% we have to see for first year. 12% for first year, whatever is the factor, we take that. So it is 0.893. I hope all of you have that table. Okay, so 0.893. Then 12% for second year is 0.797. You need to keep checking it here. You can see here 0.893, 0.797, 0.712, 0.636, 0.567. This table you will get it behind any financial management textbook. At the end, they basically give this table, or you can also Google it, the present value interest factor table, or for different interest rates, you will get it. But it's always better to take it from a textbook, which is at the end of every financial management textbook, they will usually give you this. Okay. So 0.797, then the next is 0.712. So I'll just write the rates for all the 6 years. 0.636, then 0.567, and 0.507. So these are the present value interest factors. Now we need the present value of cash flow. To find the present value of cash flow, you need to multiply the cash inflows 48,000 into the present value interest factor, that is 0.893. You will get the present value of cash flow for first year. Similarly, second year you multiply 32,000 into 0.797, you will get it for second year. So we have to continue this for all the 6 years. We have to multiply the cash inflows with the present value interest factor of all the 6 years and then find it. So 48,000 into 0.893, if I do, I'll get 42,864. So similarly, if I do it for all the years, these are the values that you will get. Now we need to total all these present value of cash inflows. So once we find the total, we'll get the present value of cash flows. We'll add all these. 1,02,300 is the present value of cash flows. I'll write here PVCH, that is present value of cash flows. Now I have told you the NPV formula, so I'll write it here for you. NPV is equal to present value of cash flows minus initial investment. So now NPV will be equal to present value of cash flows is 1,02,300 minus initial investment they've given here. It is 1 lakh rupees. You can see this year 0, the investment is 1 lakh. So minus 1 lakh, your NPV will be equal to 2,300. It is a positive NPV. That means the company is earning more than its investment, 2,300 rupees more it is earning. So your NPV is positive. Okay, make it red. Now let's do the same for project B. So we'll copy. Okay. Now the cash flows are different for project B. So we'll find the cash inflows. Present value interest factor will be same because for both the projects the cost of capital is 12%. So once you have written the table values, we can use the same table values. Let us take the 6 years cash flow for project B. These are the cash flows. Now what we have to do, we have to do present cash inflows into present value interest factor. So 20,000 into 0.893, 17,860 is what you get. Similarly, 24,000 into 0.797, 19,128 you get. So like that for all the years, if you multiply it with present value of cash inflow, you will get the present value cash flows, and the total present value cash flows is 1,06,276. Again, we'll find the NPV. You know the formula of NPV now. It's present value of cash flows, that is 1,06,276 minus initial investment, which is 1 lakh, which is same for both the projects. So 6,276 will be the present value of cash flows. Sorry, will be the NPV. So for project A, the NPV was 2,300. For project B, the NPV is 6,276. Now tell me which is the highest NPV, A or B? Project B is the highest NPV. So therefore the company should be selecting project B. So when we are thinking of investing in either A or B, we are thinking to invest in B because it is giving the highest positive NPV. So here we will write the comment, the company should select project B as it has highest positive NPV. Okay, so this was the problem on how to find the NPV and how to write the comment. So we have done it for project A and B both. Let's go to the next sum. If anybody has any doubts in this problem, please ask. Let's go to the next. Mahavir Limited is planning to invest in a project which requires an initial investment of rupees 12 lakhs with the life of 6 years. The cash flow before tax and depreciation are given below. So here these are cash flows before depreciation and tax. The cost of capital for the company is 13%. The tax rate applicable is 40%. Straight line method of depreciation is followed. You are required to calculate NPV. First, let us understand the question. So what the question is trying to say is, these are the cash flows before depreciation and tax. And what we want is only cash flows. You see here, this problem, these are only cash flows which are given. We just want the cash flows. We don't want cash flows before depreciation and tax. So how to get the cash flows? To get the cash flows, we need to remove this depreciation and tax. So if I have to remove this, that means I have to minus this from my cash flows. So the very first step is to minus the depreciation and then the tax. So what is the amount of depreciation? We need to find it. They have told to use the straight line method of depreciation. So let's solve. First we'll do working note on depreciation. Okay, they're asking us to do straight line method. So depreciation is equals to, we remember the formula of straight line method of depreciation. It is cost minus scrap divided by life of the project. So we'll use this formula and calculate depreciation. Okay, so cost. What is the cost here? See here, they have told the initial investment is 12 lakh. That means this is the cost of the project. We are going to invest 12 lakh rupees in the project. So for me, the cost is 12 lakhs. Minus the scrap is 0. They have not given us the scrap value. So that remains 0, divided by life of the project. So now we should see for how many years this project is going to work. So it's going to work for 6 years. So the life of the project is 6. So if we do 12 lakh divided by 6, we will get the depreciation amount as 2 lakh. So this is the depreciation, 2 lakh rupees. Okay. Now using this, we'll calculate our cash flow. So here we will need a lot many columns. So instead of doing it in your books vertically, you can solve it horizontally because we need almost 10 columns to find the answer. So let's start with doing it. So here, first column we'll have year, then we'll have cash flows before depreciation and tax, then we'll have depreciation, then cash flows before tax, then we'll have tax, cash flows after tax, again depreciation, and then we have cash flows, present value interest factor, and present value of cash flows. So almost 10 columns. Okay, so let's start one by one. First, we'll write down the years. So the
Excuse me,
project is
ma'am.
for 6 years. Yes, tell me.
Ma'am, why we have taken two times depreciation?
I'll tell you. When I'll solve, I'll explain you why we are taking it 2 times. Okay, just give me
Okay,
some
madam.
time. Yeah. Okay, 6 years, and these are the 6 years cash flows that we are going to use. Now, what we'll do, we have calculated depreciation 2 lakh rupees here. So we are going to use this amount 2 lakh rupees as depreciation amount in our problem. So here we will write depreciation 2 lakh for all the years because it is straight line method. Straight line method means same depreciation every year. So we are writing 2 lakh, same depreciation every year. Now we want cash flow before tax. So to find cash flow before tax, if I number these columns, no, this will be column number 1. Sorry, the year 1 will be column number 1. This will be 2, column 3, and this is column 4. So how do you derive at column 4? Column 4 is equal to 2 minus 3. Why 2 minus 3? Because column number 2 minus column number 3 will give you cash flow before tax. So from cash flow before depreciation and tax, I am removing this D. So if I remove this D, I will get cash flows before tax. So from 3 lakh, I'll minus the depreciation 2 lakh to get the cash flow before tax. So 3 lakh minus 2 lakh, it is 1 lakh. Similarly, for every year, we will go on minusing the depreciation amount. Then 3 lakh 60 minus 2 lakh is 1 lakh 60. 4 lakh 80 minus 2 lakh is 2 lakh 80. Then 4 lakh 50 minus 2 lakh is 2 lakh 50. 4 lakh 46 minus 2 lakh is 2 lakh 46. And 4 lakh minus 2 lakh is 2 lakh. So these are the cash flows before tax. Now they have told that the tax rate is 40%. So tax we are going to calculate at the rate of 40%. 40% on the cash flow before tax. So this part, the cash flow before tax that we have here, 1 lakh rupees. On this we'll calculate 40% tax. So on 1 lakh, 40% tax will be 40,000. Similarly, on 1 lakh 60,000, we'll calculate 40% tax. So on 1 lakh 60, 40% will be 64,000. Then on 2 lakh 80, we'll calculate 40% tax. It is 1 lakh 12,000. Similarly, we'll have to go on doing on 2 lakh 40, we'll calculate 40%. You get it as 1 lakh. And 98,400 and 80,000 accordingly are the tax rates. Okay, so on 2 lakh 46 and on 2 lakh. So these are the taxes. So from cash flow before tax, we will minus tax to get the cash flow after tax. So 1 lakh minus 40,000, you will get the cash flow after tax, that is 60,000. So you see 1 lakh minus 40,000, it is 60,000. Similarly, 1 lakh 60 minus 64,000 is 96,000. 2 lakh 80 minus 1 lakh 12 is 1 lakh 68, and so on. So now again we have taken depreciation, so we will write it here. Now the question asked by Ashwini, that why we are taking depreciation again. The reason is because depreciation is a non-cash expense. If you remember, when I had taught you cash flow statements, I had told you we shouldn't be taking non-cash and non-operating expenses. So depreciation, when we charge, we don't pay that money to anybody. It is not a cash outflow. It is not an expense where money is going out of the business. When cash is not going out, we cannot treat it as an expense. It is a non-cash expense. That's why we need to add it back. We cannot remove it. Okay, then why did we remove it at the first place if we have to add it back? Because if I wouldn't have removed 2 lakh rupees from here, then I would have charged tax on a higher amount. So directly tax on 3 lakh rupees, 40% would be much higher than tax of 40% on 1 lakh rupees. Whenever we pay tax after deducting all the expenses. So depreciation, interest, salary, all the expenses we deduct, and whatever remains on that profit, we calculate tax. So this was cash flow before depreciation. So first I had to remove depreciation, then I will get the cash flow before tax, and on that I charge tax. But here I remove depreciation so that I can save tax. Now I cannot actually remove depreciation and throw it away because it is not a cash outflow. We are not paying it to anybody. We are just reducing the value of our asset. So cash is not going out. That is why we should add it back. So in the first place, we deducted so that we can save tax. And now we are adding it back so that we can show the actual cash flows of the company. Is that clear, Ashwini? Any other doubt?
Yes, ma'am, cleared. Thank you.
Yeah. So now we will add it 60,000 plus depreciation 2 lakh. It will become 2 lakh 60,000. Because of the comma, it is not. So similarly, we will calculate for all the years. So we'll add 2 lakh to all the cash flows to get the cash flow before tax. Now we have, sorry, to get the cash flows. Now we have the cash flows. Now we can find the present value of cash flow. So we need to check what is the interest rate that they have given. Their cost of capital is 13%. So we are going to take 13% as a rate to find the present value of cash flow. So present value interest factor at 13%. So in the table, we have to see 13%. Okay. This table doesn't have it 12, 14, 15. Okay, I'll send you another table, photocopy, and in the photo of it on WhatsApp. Please refer that table. It has all the percentages. As of now, I will write the rates here at 13%. It is 0.885, then 0.783, 0.693, 0.613, 0.543, and 0.480. So these are the rates, present value of cash flows at 13%. Okay. So now we'll multiply the cash flows with the present value interest factor to get the present value of cash flows. So it's equal to cash flows into present value of cash flows. You'll get the present value. So 2,60,000 into 0.885, it is 2,30,100. Similarly, we will do it for all the years. So 2,96,000 into 0.783, you get 2,31,786, and so on. So at the end, we add all this to get the present value of cash flows. So this is the present value of cash flows, 12,73,789. Now we can find our NPV. So NPV is equals to present value of cash flows, which is 12,73,789 minus the initial investment. And here they've given in the question in the paragraph, the initial investment is rupees 12 lakh. So from 12 lakh 73,789, we will minus 12 lakh. So we'll get 73,789 as NPV. So this is your NPV and it is positive. So that's the reason the company should accept the project or it should invest in that particular project. Okay. Any doubts in this problem? Was that clear? How we found the cash flows? I hope it was clear. If such lengthy problem is asked, it will be asked for 10 marks or sometimes it can also be asked for case study. Is this clear, all of you? Let's go to the next problem. From the following information, calculate NPV for the following two projects. So we have again project A and project B. Year 0, they have given -20, which is nothing but the initial investment. I'm telling you again, repeating it again, even if they don't give this minus sign, we need to consider it as investment only because it is at year 0. So from 0 to 5, there are 5 years and the cost of capital they've given is 10%. So like we did for the previous problem, for project A separately, B separately, we will find the NPV. The cost of capital they have said is 10%. So we'll take it at 10%. We'll see the cash flows now. First, we're doing it for project A. So these are the cash flows: 7,000, 6,000, 6,000, 5,000, and 4,000. Okay, and it is for 5 years. So present value interest factor at 10%. We'll look at the table and we'll go to 10%. So here is the 10% at the end. 10% for first year, it is 0.909, 0.826 for second year. So I'll just record it. 0.909 for second year, 0.826, 0.751, 0.683, and 0.621. So these are the present value interest factor. Now we can multiply the cash flows with the present value interest factor at 10%. So 7,000 into 0.909, you get 6,363. 6,000 into 0.826, 4,956. Similarly, all the years, if you multiply with the present value interest factor, you NPV. These are the cash flows: 5,000, 6,000, 826, and so on. Multiply the cash inflows with the present value interest factor, and we get the present value of cash flows. So we do it for every year. Okay, and then total of it will give you the present value of cash flows, 24 minus. Now if they ask you to choose between the project 1 and the project 2, we will choose project 2 or project B, because 4,507 is higher than 1,724. So if they ask for comment, we'll write company should select project B as it has highest positive NPV. So this is how it's going to work. Okay. Now Ashwini has asked another question in the chat, that why negative, whereas from year 1 to 5 from the business cash inflow, or in a simple way, this is cash outflow. 20,000 is going out and getting into the business. business, and 7,000 is coming in back to us after the business earns certain profits. That's why it's always given in negative. But again, I'm repeating, even if it is not given in negative, even if it is not given in negative, even if it is not given in negative,